In this video, we are going to dig into the difference between FOB Shipping Point and FOB Destination, and we're going to find out what this ship has to do with what we're talking about. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my first mate, Mr. Terrence T. Rex, and we're here to put the fun in accounting fundamentals. Now, you may not know this about me, but in one of my other lives, I write historical fiction. So this is one of those moments when my accounting life and my historian life suddenly come together in a moment of pure genius. Pure genius! Let me explain that. So in days of old, when we shipped things on ships, hence shipping, we had this thing called free on board or freight on board. So I'd like to bring your attention to this picture of the ship with cargo being loaded on it. Now you see where the yellow circle is? That's the magical circle where responsibility for that shipment passes from the buyer to the seller. So once it's free on board, the seller is no longer responsible for it. The buyer is responsible for it. So if that ship goes down, the buyer is the one that suffers. So when we're talking about free on board, which is sometimes called freight on board, this is what we're talking about. We're talking about the passing of responsibility. So if something happens to that shipment, we know who's going to take the loss. So how does that relate to modern day accounting? Well, things haven't really changed all that much, other than sailing ships gave way to, trains and planes and automobiles and all of that. But we still use the same terminology. So let's look at two different types of shipping. FOB, free on board, destination, and FOB, free on board, shipping point, and how those make a difference in how we track those from an accounting perspective. So let's attack FOB shipping point first. So there was a saying in the old shipping days, back when I was a young girl and the Pilgrims and the Mayflower and all of that stuff was going on, when the cargo passed the ship's rail. So that's what you see happening in that picture that I put up, which, by the way, was from the Library of Congress, a repository for many wonderful pictures in American history. So under FOB shipping point, the ownership passes at the shipping point. Okay, so it all comes back to, when does ownership pass? Who is responsible? So ownership passes at the shipping point, and that could be when it crosses the rail onto the ship, or it could be when it's dropped off at the post office, or when UPS picks it up, and at that point, the seller is no longer responsible. If something happens to that shipment, then it is the buyer who takes the loss. Now, the way I like to remember this is, I think about like buying something from eBay, where you are paying for the postage. Once the seller ships that piece of merchandise, whatever it is, once they ship it, they are no longer responsible for that merchandise. So if it gets damaged in shipping, it's not going to be them that's paying for that. So it's either going to be you, the buyer, or it's going to be the shipping company if something gets destroyed on its way to you. So FOB shipping point, I think of as eBay. You could think of it as shipping point eBay. See, you're shipping things across the bay like eBay, and we handle that one way in accounting and a different way for destination. So every transaction for shipping has two parts to it. We have the buyer side and we have the seller side. So when we're talking about FOB shipping point, so for the seller, there is no transaction to do because the buyer is paying to have it shipped. We're eBaying it to you across the bay in the ship. So what happens for the seller is that there is no entry in this case because the buyer is bearing the cost. On the buyer side, assuming that we are using perpetual inventory, what we're going to do with that cost is we're going to add it to our inventory amount. So we're going to put it into merchandise inventory if we're buying things for our store, for example. Because what this is doing is it is recognizing that this is part of the cost of buying that merchandise. Now let's say we're talking about FOB destination. So the ownership under FOB destination passes at the delivery point. So it's not when that crosses the rail, it's when it actually arrives where it's supposed to go. And that delivery point could be a warehouse, it could be an auto dealership if they're buying new cars, it could be your mailbox is the destination. And I think of this as kind of the Amazon model here. So Amazon is shipping this to you. Let's say you're a Prime member and shipping is free. Although, newsflash, there's no such thing as free shipping. The shipping is in the cost of the product and your membership. But under that scenario, the seller is responsible up to the delivery. So Amazon is responsible for that delivery until it actually gets to you. Now, if there's a damage on the way there, then it's going to be between Amazon and UPS, for example. But it's FOB destination. You are not responsible for it until it actually gets delivered to your house. So what does that do for us on the accounting side? Under FOB destination, what's going on with the seller, though, is the seller now has an entry to make because they have spent money to pay for shipping. So what we're going to do if we are doing the seller's side of the books, is we're going to have an account called delivery expense or freight expense, postage expense, whatever the account is called in our chart of accounts. So it's going to be something like delivery expense, debit, and then a credit to cash or accounts payable. So it all comes down to who's responsible and who is paying. So under FOB destination, the seller is paying and the seller is responsible until it's delivered to the destination for the buyer. So there you have it. A little bit of history, a little bit of accounting. It's all good. So until next time, stay balanced, my friends.